If you own a home and you are 65 or older, there is a very good chance you are overpaying your property tax bill every single year. Not because the law requires it, but because nobody told you which form to file. That is what this video is about. And before you decide this is not for you, I need to address something directly, because this is the biggest misconception I run into on this topic. Some of you are thinking this is only for low-income retirees who are really struggling. If your home is paid off and you are reasonably comfortable, you tune it out. Others assume the opposite, that this is only for people with expensive properties. So if you are living mostly on Social Security, you stop listening. Both of those assumptions are wrong, and I am going to prove it to you in the next few minutes. And if you are renting right now and you think none of this applies to you, it does. Your landlord is paying a property tax bill and passing every dollar of it to you through your monthly rent. When that bill goes down, the pressure on your rent stops climbing. Here is the number that should get everyone's attention. The average American homeowner over 65 is sitting on at least 5 legal forms that can stop, reduce, or permanently freeze their annual property tax bill. 5 forms. The average annual property tax bill in this country runs around $4,800. For someone who is 65 today and stays in their home another 20 years, that adds up to close to $100,000. And a significant portion of that money, for many of you watching right now, should legally be zero. Let me walk through this together step by step. The reason almost nobody talks about these forms comes down to one uncomfortable fact. The county assessor's office is funded by the taxes it collects. Every dollar in exemptions they grant is a dollar their office does not get to spend next year. So the county does not call you on your 65th birthday and mail you the senior exemption application. Your mortgage company does not flag it on your statement. The real estate agent who sold you the house never brought it up. Being legally exempt from paying a tax and actually not paying it are two completely different things. The law does not refund you automatically. You have to know the form exists and you have to file it yourself. That is the entire reason I am making this video. I want to be clear, I am not a financial advisor and nothing here is personal legal advice for your specific situation. These rules vary by state and county, and you should always confirm the details with your local assessor's office or a licensed professional in your area. What I can do is show you exactly what to ask for and why it matters. Now, I am going to cover 5 forms and then 3 bonus moves at the end. Stay with me through all of it, because the last bonus move is the one that quietly costs people the most money, and it is also one of the easiest to act on. Form number 1 is the homestead exemption. This is the one most homeowners assume they already have on file when in fact they do not. Every state in the country, with only a small handful of exceptions, offers some version of a primary residence exemption. What it does is simple. It deducts a portion of your home's assessed value before the county calculates your tax bill. In Florida, that amount is $50,000. In Texas, it is $100,000 applied to the school district portion of your bill. In Illinois, $6,000. In Georgia, $2,000. The numbers vary by state, but in every case, there is real money on the table. Here is where people get tripped up. In some states, this exemption applies automatically when you buy the home. In most states, it does not. You have to file a 1-page form at the county assessment office. Usually by April 30th of the year, you want it to take effect. Miss that deadline and you pay the full bill that year. File it once, and in many states, it stays on record as long as you own the home. One piece of paper filed once, and for some of you, that means hundreds or even thousands of dollars off your bill every single year going forward. I also want to tell you this. The homestead exemption is the gateway. The county will not let you claim the senior freeze, the deferral, or most of the other relief programs on this list unless your primary residence is already on file. So if you do one thing after watching this video, call your county assessor's office tomorrow and ask one question. Is the homestead exemption currently filed on my property in my name? If the answer is no, ask what form you need to file to add it. That is form number 1. And for many of you, it unlocks everything else. Now, here is something I want you to hold on to while we go deeper into the next forms. We are going to get to the one that the county is most determined not to mention, and it is the one that can literally freeze your tax bill at today's number for the rest of your life. Keep watching. Form number 2 is the senior or over 65 exemption. Most states that offer a homestead exemption also offer a separate additional exemption that kicks in the year you turn 65. This is a separate form. You have to ask for it by name. The county almost never mails it to you proactively. The amounts vary significantly. In Texas, homeowners 65 and older receive an additional $10,000 deduction on the school district portion of their assessed value. On top of the $100,000 homestead amount, in Florida, the senior exemption can add another $50,000 on top of the basic 50, effectively doubling the total deduction. In New York, the senior exemption can reduce the assessed value by up to 50% for qualifying seniors. In Illinois, an additional $8,000. Now, here is where a lot of comfortably retired homeowners stop paying attention, and they should not. Many states do put an income limit on the senior exemption. New York's threshold is around $58,000 in household income. Illinois is around $65,000. If you are above those lines, you assume you do not qualify and you never file. But more than half the states with a senior exemption have no income requirement at all. In Texas, Florida, Georgia, Tennessee, Mississippi, Alabama, and others, the senior exemption is based on age alone. Your income does not matter. The value of your home does not matter. You turn 65, you file the form, you get the exemption. So if you are 65 or older and you live in your own home anywhere in this country, your assignment right now is to call your county assessor and ask 3 questions. What is the senior exemption application for this county? What are the eligibility requirements? And what is the filing deadline? Get the form, file it once, and stop overpaying. Social Security rules, tax thresholds, and programs like these change every year, and nobody from the government is going to call you and explain what any of it means for your situation. That is exactly what this channel is here for. Subscribe and turn on the bell so you do not miss it when the rules shift. Before I go to form number 3, let me pause for a moment. Because right now, in this video, we have already covered the gateway exemption that most homeowners assume is filed when it is not, and the age-based exemption that is sitting unclaimed for millions of people simply because the county never mentioned it. What is coming next goes even further. We are going to talk about permanently freezing your tax bill, stopping it from rising no matter what your neighborhood does. We are going to talk about a program that literally sends you a check if your taxes take too big a bite out of your income. And then we are going to get into a move that is especially powerful if you own a home with significant equity but not a lot of monthly cash flow. All of that is in this video, and I've put together a deeper resource that goes further than what we can cover here. It is called the Hank Sullivan Retirement Protection Pack. You can find it by clicking the link in the description below, or if you are watching on a screen right now, scan the QR code showing on screen. Either path gets you there. Now let's get into the forms that most people have never heard of. Form number 3 is the assessment freeze, and this is the most valuable form on the entire list. Here is what it does. When you turn 65 and you file the freeze application, the county locks in your home's assessed value at whatever it was the year you filed. From that point forward, it does not matter how much your neighborhood appreciates, how much comparable homes sell for, or how hot the real estate market gets. Your property tax bill is calculated on that frozen number, not on the current value. Let me do the math live so it lands. In Texas, once you turn 65 and file for the senior tax ceiling on your school district taxes, the actual dollar amount of that portion of your bill is locked, not the assessed value. The dollar amount of the bill itself, your home can triple in value. The bill cannot go up. In Illinois, the senior assessment freeze holds your adjusted assessed value steady as long as your household income stays below a state set limit. In New Jersey, the senior property tax freeze reimburses you every dollar of increase above the year you first qualified. Different mechanics, same result. The bill stops growing. Here is where comfortably middle-class retirees get hurt the most by not knowing this form exists. If your home was worth $220,000 when you turned 65 and it is worth $440,000 today and you never filed for the freeze, you are paying taxes on every dollar of that appreciation and you will keep paying on it for the rest of your life. The homeowner across the street who filed that form is paying taxes on the number 220. Same house, same street, same year built. 2 completely different tax bills. The only difference is one of them filed one form. One important rule about the freeze. In most states, you have to apply within a specific window, usually between January 1st and April 30th of the year you turn 65, or in some states the year after. miss that window in some states and you lose the freeze permanently. That is why this is the form I talk about most urgently. Call the county now, ask for the senior assessment freeze or senior tax ceiling application by name. Even if you turned 65 3 years ago, in many states you can still file. The exemption applies going forward, not backward. Every year you wait is another year of overpayment you will never get back. Form number 4 is the circuit breaker, and this one is aimed squarely at homeowners on fixed or modest incomes. The name comes from the concept that when your property tax bill exceeds a certain percentage of your income, a switch flips and the state sends you the difference back. But nearly every state has some version of it. Here's how it works in plain language. You file an application with the state, usually as part of your state income tax return, even if you owe no state income tax at all. You report your household income. You report the property tax you paid that year. If your taxes exceed a percentage of your income, typically somewhere between 3 and 6% depending on the state cuts you a check or credits the difference against your state taxes. The amounts range from a few $100s a year to over $1,300. Massachusetts, Maine, Vermont, New York, Michigan, Minnesota, Missouri, Maryland, Wisconsin, and Illinois all have versions of this program. And the income limits in most states are not as low as you might think. In New York, the basic credit threshold is just under $29,000 in household income, and an enhanced version kicks in at a higher level. Maryland's threshold is around $60,000. This is not a poverty program. This is a program for middle-income retirees on fixed incomes, and the application is usually a single page tucked into the back of your state income tax instructions. If your state is on that list and your household income is under roughly $60,000, search for the words property tax credit circuit breaker and your state name and file the form. Some states will reimburse prior years, some only go forward. Either way, the form is free, it is one page, and the money is real. Now, form number 5. This is the one I promised you at the start, the one that the county treats like it does not exist. Form number 5 is the property tax deferral. Here is what it does. If you are a homeowner above a certain age, generally 62 or 65, depending on the state, and you have lived in your home long enough to meet the residency requirement, you can apply to defer your property taxes entirely. Not reduce them, defer them. Stop paying them completely. The state pays the tax on your behalf, and the unpaid taxes become a lien on your home that gets settled only when you sell, refinance, or the home passes to your heirs. For a homeowner who has a valuable home but limited monthly cash flow, which is the exact profile of millions of older Americans in this country, this is life-changing. You can stay in the house where you raised your family for the rest of your life without writing a single property tax check to the county. Oregon, California, Washington, Colorado, Texas, Tennessee, Idaho, Illinois, Massachusetts, and several other states offer some form of senior property tax deferral. And this is not only for low-income homeowners. In several states, the deferral is available regardless of income. The interest rate the state charges on the deferred amount is low, in many cases between 2 and 6% simple interest, and the lien sits on top of your equity. One rule you need to know: if you still have a mortgage, check with your lender first, because some mortgage contracts treat unpaid property taxes as a default trigger. For a home that is already paid off, the deferral is clean and straightforward. One application, usually filed at the county treasury or the state revenue office. Annual renewal, the tax bill disappears. Every year you keep paying a tax you could have legally deferred is a year you pulled money out of your retirement savings and handed it to the county. Now, 3 bonus moves for anyone watching with some assets, because these next few minutes could be worth more than everything I just covered. The first bonus move is for anyone who served in the military. The disabled veteran exemption exists in nearly every state, and depending on your service-connected disability rating, it can eliminate your property tax bill entirely. In Texas, Florida, Virginia, Pennsylvania, and many other states, a 100% service-connected disability rating means a lifetime full property tax exemption on your primary residence. Even a partial rating, 30, 50, or 70%, usually translates to a proportional additional exemption on top of everything else on this list. The form is typically 1 page plus a copy of your disability letter from the VA. If you served, file this form. If a parent or spouse served, find out whether the exemption is transferable. The second bonus move is the surviving spouse carryover. When an older homeowner passes away, their senior exemption, their tax freeze, and in many states, their disabled veteran exemption do not automatically transfer to the surviving spouse. You have to refile, usually within a year of the death, and the surviving spouse generally needs to be at least 55 years old. If a spouse passes and the survivor does not file, the property tax bill can jump overnight, sometimes by thousands of dollars, for the same household that just lost half its income. Most counties will let that happen without saying a word. The form is short, the deadline is real. Do not let the county quietly reclaim your spouse's exemption. The third bonus move has nothing to do with a discount the county is offering you. This is your right to protest your assessment. Every property tax bill is based on an assessed value that a county appraiser assigned to your home, usually someone who has never set foot inside it. They use comparable sales, square footage, assumptions, and they get it wrong all the time. Every county in this country gives you the right to protest that value, usually within 30 to 60 days of receiving your assessment notice. You file a one-page protest, bring 3 comparable sales from your immediate neighborhood that came in below your assessed value, sit in front of a review board for about 15 minutes, and in a significant share of cases, the assessed value comes down, sometimes by tens of thousands of dollars. That means hundreds or thousands of dollars off your bill that year and every year after. Filing costs nothing. You do not need a lawyer. The county will not announce it. And in most counties, fewer than 5% of homeowners ever file a protest, even though close to half of all protests that do get filed result in a reduction. Challenge your assessment every year, and especially the year you turn 65. Here is the bottom line, and I want you to hear this clearly. None of this is automatic. Your county will not call you. Your mortgage company will not catch it. Your tax preparer will almost certainly never mention it. Every form on this list is sitting on a shelf at your county assessor's office waiting for you to walk in and ask for it by name. The homeowners who are getting these exemptions are not luckier than you. They are not wealthier. They simply knew the form existed. You did nothing wrong. The system just does not tell you this. That is exactly why this video exists. If you are not sure where to start, this is what I want you to do this week. Call your county assessor's office. Ask whether the homestead exemption is currently on file for your property. Ask about the senior exemption. Ask about the assessment freeze. Write down the deadlines they give you. Then call your state revenue department and ask about the circuit breaker credit and the deferral program. Every one of those calls is free. Every one of those forms is free. And the money you keep as a result is real money that belongs to you. If you know someone over 65 who is still paying their full property tax bill, share this video with them today. What they do not know could be costing them $4,800 next year, plus years of increases on a bill that a single form could have frozen in place. What exemption are you going to call about first? Drop it in the comments. I read every single one.